Great.
You got it, Barrett.
All right, thanks. So this is the Investment Advisory Committee meeting for June 22nd, 2023. We'll call it to order at 2:03 p.m. Present are Commissioners Tony Badalamenti and Sabrina Christian Bennett, myself, Treasurer Brad Cromis, and Eileen Stanek from Meter Investment Management. So we'll go ahead and get started with the approval of the minutes from our March 23rd meeting.
I'll move to approve the past minutes.
I'll second.
Okay, moved and seconded. All in favor, please signify by saying aye.
Aye.
All opposed, same sign. Motion carries. All right, so we are ready for our report. We are in New Digs today, so it's very
Yes.
exciting. Thank you for making your way up here. Hopefully this will be a little bit more convenient for everybody going forward.
Yes.
And that the stream works all right. Only note I would make before you get into the portfolio itself, when I have live streamed these, I have put these on the screen for us.
Oh,
We
right.
may do that in the future, but for this
Okay.
one, I'll just post this over to the website and people can go check out our website under the investments tab to find this document. So
Okay, perfect.
with that, floor is yours.
All right, well, thank you. Wonderful day here, second day of summer.
Yes. That's cool.
Yes, nice and cool, but kind of feels like fall, right?
Mhm.
But kind of the mixed weather, and that's what we're seeing here in the economic news as well, is some mixed news.
It's a great segue. Good job.
No pun intended.
That's pretty good. It got a little cooler.
Yes.
Way cooler from yesterday. It was
Yes.
hot.
But we did have the Fed meet here earlier this month, and if we look at page 3 in the report, what we're showing here is a comparison of the dot plot. This is the forecast that each member of the FOMC committee presents at the meeting as it relates to where they believe is the appropriate level of the overnight Fed funds rate at the end of each year. And we're comparing the forecast from March, which is the blue dots, to the forecast in June, which is the orange dots. And what we can see here is that the participants have upped their forecast for where the appropriate level of the overnight rate should be in 2024, with setting the expectations that we could expect 1 to 2 more rate hikes in 2024. But then when we shift into 2024, shifting and lower rates in 2024 and in 2025, but not necessarily at the same pace that was previously projected.
I was gonna say that's only like 1 or 2 drops compared to 8 rises. So,
Yes,
yeah.
exactly, right.
Counting.
So may not
Yeah.
necessarily be as fast on the way down as it was on the way
Yeah.
up. And that's a very good observation. Also from the standpoint as we look at this trend of lower rates going forward, it's the expectations are not that we will get to the lower rates that we experienced for the past 15 years. So we will still be in over the past, compared to the past 15 years, still a historically high level of rates,
Yeah.
which will, of course, as we know as an investor in fixed income securities, will allow us to continue to benefit from those higher rates. Now, when the Fed did meet, they did this time decide to pause or skip, doesn't matter, kind of a little semantics there. Did they just skip a meeting? Are they going to pick back up next meeting? Is it a pause? Will it take a few more meetings before they pick things back up? But clearly kept the rate at the current level from the standpoint of they want to see really how things fall out as post the banking crisis, because the expectations are that with the banking crisis there will be increased regulation on banks as well as some tightening of credit, and how that could flow through to the U.S. economy as well.
So I thought I heard that the chairman more or less indicated that this is like just a skip versus a pause.
Yes.
Like, so the next meeting, the expectation I think, right, is that it's going up again
Yes.
at the next meeting then? Okay.
Yes. He used the word live.
Okay.
Yes.
Gotcha.
The next meeting will be a live meeting.
meeting, okay.
Yes, and so, to your point, Brad, absolutely right. He did characterize it as a skip versus a pause. You know, the market is recognizing that a lot will depend on the economic data.
Right.
And if the economy continues to show some signs of softening and inflation continues to, drop as it has been, that, there is that potential that the Fed could feel compelled to skip another meeting. And now we start to really introduce that concept of, is it more of a pause versus just a skip? It's semantics.
Okay.
Yeah, I think the Fed was afraid to use the word pause.
Right.
But the market comes to their own conclusions as well. And we see this particularly when we flip over to the next page. This is where we're showing the Fed funds futures expectations of where that overnight rate should be and how that varies based on economic news. So we show here as our starting point the orange line, which is December of 2022, the Fed's projections. And we can see, looking down to the darker blue line, on January 27th, when economic conditions were a little lighter, that the market was then shifting their expectations that rates would be lower, that the Fed would not be able to get rates as high as they were projecting. And then, of course, even in 2023, we would start to have rate cuts. We then received some strong job numbers, inflation not falling as quickly as expected. And by March 8th, just a little over a month later, market expectations had moved up. And expectations were that not only would the Fed be able to raise rates, but be able to increase them higher than they had projected and keep them there for a little bit longer. But again, before starting to cut rates in 24. And then, of course, we had the banking crisis. That's the green line. And at that point, of course, the market had this great sense of fear. Because as we know, anytime there's uncertainty, there was a lot of unknowns at that point. The market really shifts into this risk-off environment and this thought process that, the sky is, I would say, falling, because we just don't know. And so the expectations at that point were that the Fed would have to cut rates sooner, but again, continuing this trend of when we get into 2024, particularly rates would be lower. So I think, our takeaway from this is that the market is very much so reacting to the news, so the market is live. Just as Fed Chairman Powell said, the next meeting will be live. They'll be looking at that economic data, be looking at the market conditions and making their decisions based on that, just as the market does every day. But it's interesting to see that the expectations that the Fed has set for out in 2024 is lower rates, and that was consistent and has remained consistent with what the market is expecting as well. That when we get into 2024, whether it's early or late, mid, that rates may be lower.
Do we know what this looks like today? This is January, February, March.
Yeah,
It looks like.
yeah, exactly. This
So.
is a little, the lines are dated, but purposefully, but when we
The
look at
story is
where they are
volatility, I
today, the
understand.
story is still
Yeah.
the same,
Yeah.
and the trend is still the same.
Okay.
Right. And I think really the next page kind of speaks a little bit to that point. Brad, when we look at the volatility that we're seeing in the two-year Treasury, because the two-year Treasury is somewhat of a proxy of what where the market believes the overnight rate will be in the next 2 years, and we can see that in this bottom chart's a little not quite as clear because there's so many observations, but we can see the significant volatility, the changes, day-to-day changes in the price of the two-year Treasury. We continue to have volatility heightened compared to the lack of volatility we experienced during the COVID times. And it's very traditional to experience volatility in our markets when we're in an environment of increasing or changing monetary policy, whether it's on the upside or the downside, because there's a increased level of uncertainty of how fast, how far will it need to go. And so at this stage, we are still in, having this volatility from the standpoint of, yes, we know now today the Fed has kept rates unchanged, but they've opened the door that it's going to continue. We see those dots. There's a little more dispersion on the dots. So clearly there's a little more lack of consensus, we would say, within the committee members, even though there was no dissension in the statement or in the vote. So there's again, a little bit of a mixed message there,
Mhm.
whereby as a committee, they all voted to the skip, but on their forecasts, they do have some dissension there. And so this is also feeding into this continuation of some volatility. But in the same token, we have seen the 2-year Treasury move up a bit. And again, that's a reflection of the likelihood, that possibility that we'll have another rate hike or two in 2023. But then in 2024, things will start to shift. Because otherwise, we would expect that 2-year Treasury to be higher than where the overnight rates are today, which they're not, which it is not. The labor market has been a very important element of the Fed's decisions and the Fed's conversations, from the standpoint of it has continued to remain resilient. When we look at the non-farm payroll numbers, and those are the blue bars, that reflects job growth on a month-to-month basis, we can see that the job growth has remained positive. The 3-month average, which is the orange line, has kind of ticked back up. It never goes in a straight line anyway, but it did kind of dip there for a bit, but has ticked back up. And we have the unemployment rate sitting at 3.7%. The number of job openings is still very strong. A little over 10 million jobs.
Is that the
open
national
jobs.
rate, the
Yes.
3.7? I was gonna say, because
Yes.
Ohio's is a little higher,
Yeah,
as well
Ohio
as the
does.
counties.
Yeah, it does tend to lag
Mm-hmm.
the national rate. But yeah, the number of jobs opened still remains elevated, but we have started to see some cracks in this from the standpoint of the initial claims for unemployment insurance have started to rise. We're now, of last read, we've been averaging about 260,000 new people applying for unemployment insurance each week. And that's up from a lot, we had been hovering around 200,000 per week. So that is a signal to us that the job market is starting to slow. And I know that's one thing that we've talked about, which is, we've started to see an increase in the number of companies laying off, freezing, some of the, at least the job opening signs or the
Yeah, in certain sectors.
yes.
Like mine, the real
Mhm.
estate, it's, yeah, people are not hiring gangbusters, like, cause it's starting to come down.
Yeah, exactly. And so that's, we're starting to see those variety of industries converge as far as it relates to cutting back on staff and the like, and starting to see it's coming up here in this increase in the number of folks that are filing for unemployment insurance.
I can tell you the number of fraudulent claims are still up. I just got a letter on Saturday, someone who's never worked for me, and that's like the 3rd one. So I had to call
Really?
unemployment yesterday in Lima and tell them, and they're like, please check no, they never worked, and send it over. So really weird.
That is weird.
Yeah.
Yeah, I know, I think it was about 3 weeks ago, I think the state of Massachusetts had a big influx of fraudulent claims.
Yeah. This is
Yeah.
like the 3rd one over the last 2 years that I've received, but I literally sat there, I'm like, who is this?
Yeah,
And yeah, it was no one that has ever worked for me, so.
interesting. People are bold.
Well, right, I mean, as
Yeah.
that stuff gets, it's, you know, that system is rife with that kind of problem
Yeah.
anyway, but then you layer on the fact that so
Yeah.
much of it is now electronic and the capacity to do it from anywhere.
That's
Yeah.
true.
You know, it's the same thing with fraudulent checks, right? I mean, we see a lot more of that now than we ever have, and it's the same kind of thing. It's a phenomenon where I could be sitting in, you know, my hotel room in Singapore, you know, or wherever. So, yeah, big problem.
It is a big problem.
problem.
I agree.
Yeah.
Definitely. But we've seen all of this play out in the yield curve when we look at page 7. The dark blue line on the bottom shows us where interest rates were a year ago. The turquoise line demonstrates where rates were at the end of May. Today, they're up just a little bit, but this is not too far off from where rates currently are. But we can clearly see there's not only are rates higher, but there's also been a change in the shape of the yield curve. And that is really the important message that we take away from the market. when we have this inversion in the yield curve, it is generally a reliable indicator of a recession, you know, on the horizon, whether that's 6 months or 18 months. But it is a very reliable indicator. And the other factor too, as we look at this, is that the inversion is quite steep. So that the short-term rates, of course, as the Fed has moved rates up higher, that gap between short-term rates and longer-term rates is very wide. It has been in excess of a full 1%, which is a little unusual. The orange line here demonstrates kind of where we had term rates kind of peak out during this cycle so far, where the 2 to 5 year rates were relatively flat, but were significant, not significantly I should say, but rather higher than where they are here today. And again, this is where the market starts to factor in as time passes, the higher likelihood of a recession. So we've looked back at the past interest rate cycles and recessions going back to the 90s to gauge, okay, on average, from the time that, you know, the curve inverts and then the Fed does shift rates, how long does it take for that to occur? And then what happens with longer term rates? How quickly do they drop, and how much do they drop? And generally that whole process, once it starts, takes about 10 months. And the longer end of the curve will also drop significantly, upwards of around 2%. So this supports, from our standpoint, as we're looking at strategy and maintaining this approach of wanting to lock in longer term rates, that it supports that decision, that we want to make sure we get these rates locked in while they're still there. Now, this last page within the economic piece is just showing short-term rates. This is a national index of local government investment pools. So this would include like Star Ohio. And again, as we know, very quick ascent to current rate environment here in this cycle. But when we look back at these over the past over 15 years here, you know, we can see going back to the 05-06 time frame, you know, rates did rise relatively quickly there. Of course, coming out of the housing crisis in the 2015 to 18 time period, Fed was a little slow to raise rates, but they did increase them. But the key point is that once the Fed completely pauses and then they start to shift down, these overnight rates drop just as quickly as the Fed movement does. The other takeaway here is, you know, while we don't have reason to believe that the Fed would need to cut rates back down to those zero levels again, we do know that if something unforeseen were to happen, they've done it twice, and we don't feel that they would hesitate to do it again. I think it's now clearly a tool in their toolkit. But we know from a long run perspective, the Fed's objective is, if inflation is back down to 2%, the economy is not running too hot, i.e., you know, jobs and the like, then the appropriate level of the overnight rate would be around a 2.5%.
Eventually.
It would be sad
At some
compared to
point.
today.
Yeah,
right. Very sad.
And inflation right now is at what?
4.
4, yeah.
Yeah, for the CPI.
So, and that's significantly reduced, but
Right.
not as quickly as
Yes.
maybe people thought, so.
Exactly. And still exceeding the Fed's target
Right,
of 2.
right.
So when we hear Fed Chairman Powell say that they still have work to do, that's what he's referring to, is they still have work to do to keeping rates to a point that will help to continue to push that inflation rate down. And of course, they've made it very clear that if that means sacrificing the growth of the U.S. economy, if that means sacrificing the unemployment rate, the low unemployment levels that we've experienced today, well, then those may be, they feel those could be necessary in order to accomplish getting inflation back under control. All right, county's portfolio. This is where we stood as of the end of May on page 10. 51 million in liquid funds. This would be primarily in Star Ohio and other money market accounts. So this is where we're earning those very high short-term interest rates. And that, of course, is balanced off by the investment portfolio at 168 million, which as of the end of the month was earning a 2.75%, which is significantly higher than where it was last quarter. So it does continue to march up as we are reinvesting maturities in the current interest rate environment. The portfolio has a weighted average maturity of 2.4 years. On an annualized basis, so this is a 12-month forward basis, the portfolio will generate about $4.6 million of interest income. So far to date, for 2023, the county has received just under $1.3 million, and that is just on the investments. The interest income that's been received on the cash portion so far this year has been very close to that. So if we were looking at the total picture of income earned on cash and investments, already today it's over $2 million.
So the silver lining of the high rate environment is that the portfolio looks good.
Yeah.
And, this carries forward to rainy days where
Yes.
that is not the case, right? It gives us extra cushion, so.
Exactly, that's exactly right. Asset allocation, we're diversified across the investment securities that are permissible, primarily though in U.S. Treasuries and government agency securities. As we've been, of course, placing funds a little bit longer term, that has just by nature organically led to a reduction in the percentage of the portfolio that's held in things like short commercial paper. Because we are limited to 270 days, so those investment options aren't applicable. When we look at the maturity distribution on the bottom, kind of drawing that line between how much we have maturing beyond 3 years versus inside of 3 years. Today we have, I gotta do some quick math here, what's that, 41% of the portfolio maturing beyond 3 years. That's right where we would like it to be, with 41% maturing beyond 3 years. So clearly, as we have maturities now, if we have maturities that roll down out of those buckets, we would look to continue to add there. Otherwise, we would be just reinvesting short term. So again, we're at this point where we've built up that long term allocation. We want to maintain it, and in order to maintain it, then as we have maturities, sometimes we just have to reinvest short term, and that's okay too, because as we know from a short term yield standpoint, we're able to take advantage of those very high short term rates. Recent purchases. As we can see here, we had 19 million that was invested. Maturity date wise, primarily, most of the reinvestments were out in that 4 to 5 year area, in the 2027, 2028 area. I think I should have done this before, but I think it's interesting when we look at, we were reinvesting at just under 4%, and this kind of puts into perspective this concept of locking in the longer term rates. If we take the 19,125,000 that's invested at 399, that in itself, this is a little over 10% of the investment portfolio, will generate $763,000 worth of interest each year after year after year. So again, this building that long-term sustainable interest income.
Yeah. Which we haven't seen in 15 years.
Right, exactly.
Yeah. So.
Yeah, and that's definitely played out here when we flip to the last page here, which is the year-end statistics, and we look at the historical interest. I mean, clearly, when we go back, although we have much more invested today than we did back in the, say, 2012, but at this stage even, we're recognizing that we have locked in a portion of the portfolio, and it will generate more income than what was generated in its entirety for the years 2012, 12 and 13. Just through one
Very
quarter.
good.
Yeah. Yeah, so we're gonna be at a point where we'll have record interest.
Yeah,
Right, which is
Yeah, over the
fantastic.
past 15 years, yeah.
And we're fortunate to be in a position to be able to do that.
Yeah,
Right.
exactly. Definitely. All right, any other questions, comments? Balance of the report, of course, is the inventory of the holdings that are included in the monthly statement that Brad receives each month.
Mhm. I have no questions this month.
Oh, thank you.
Sabrina, do
Any
you have
further-
anything?
no,
Okay, need a motion to accept the report as presented then.
so moved.
Second?
Okay, moved and seconded. Any discussion? Hearing none. All in favor, please signify by saying aye.
Aye.
All opposed, same sign. That motion carries. So, other business is GrowLink update, and you can pass that down, Eileen, since you didn't get one. But this is just kind of the, giving you an update on how that program is going. As you recall, we had $2 million total available as of this meeting and yesterday afternoon. There is 1.272 million in the field with another 700,000 and change available for lending. So that is being utilized. The spread is more recently tilted in the business operations space versus the homeowner space. I think that is product of kind of who's been sharing the information, the fact that Portage Development Board and some others have been advertising that, the commissioners, realtors, et cetera. So we're pretty happy with that. We're still, out there talking to folks about it and making sure that people are aware of it, but it remains a good investment. At some juncture, if we were during the next quarter to use up more than half of that, I would probably be asking us to consider bumping up an allocation there. We had initially said we could do up to 2% of the portfolio in the program and be comfortable. I don't know that we necessarily need to go that high given the size of the portfolio at the moment, but there could be an additional ask depending on what the demand is in the market for it. So just to flag that for you for the future. Not asking for that today, but potentially going forward. So any questions about GrowLink?
No.
Okay, good. So there's nothing to vote on with respect to that. So any other business for the good of the group?
No, sir.
Okay, well then hearing none, I would entertain a motion to adjourn.
So moved.
Second?
Okay, so at 2:30, without objection, we are adjourned, and our next meeting will be in September. So thank you for your time. Thanks for coming today. Thank you, Eileen. Appreciate that. Let's hope that we can
Like
keep
your
things
new
going.
days?
So.
Yes, I do. Yeah, this
Great.
is nice up here.
We just did this year.
Yeah, this is very nice, the video capabilities.
Oh.
You would have the bell. I
Come
know.
on,
And-
she knows I like that bell.
Thank you for knocking, Brad.
Yeah, you're welcome.
I was gonna throw something at the door.